Hi, everyone. My name is Maddie Bowers, and I will be presenting the liability section for Group 8. So we decided to go with a small flower shop in what is known as Sebastian, Florida. First, let me share my screen so you can get that up there. Okay, so what we have first is accounts payable. And our accounts payable, we found that by multiplying days of accounts payable, which we determined to be 30. I just decided that that was a pretty average number. So we decided to go with 30 for our days of accounts payable. So we take times 365, and then you divide cost of goods sold by that number, which gave us 3,627 in the first year. And then as you can see, for income taxes payable, it is 0. And that's because income taxes payable obviously refers to our cell that has our net income. But since we had no income for the first 2 years, we don't have any income taxes payable because you can't be taxed if you have no income. So for the first 2 years, as I said, it's 0. But then going forward, it starts to go up because we do start to actually make a profit. So then with our mortgage loan, it refers to our amortization table where it has all of our loan information. So we determined our value of our building and land to be $215,000. And we decided that our loan was going to be for 80% of the $215,000. So our total loan is for $172,000. But as you can see, for year 1, it refers to of that first year. And so it starts out with 168,454, and then going forward, it just goes to every consecutive year. I jump down to common stock. And common stock is just 10% of our total assets. So we just have that formula in there. And we just have total assets here, and then it is multiplied by 10% right up here. Just the same going forward. And for retained earnings, it's obviously just like normal. It's just net income plus previous retained earnings. But the first year, it just refers to our net income because we don't have any previous retained earnings to add into that. So we're going to jump back up to extra bank loan. So by the time we added everything else in order to get it balanced, add the extra bank loan in to balance those numbers. And so for years 1 through 5, we had to get an extra bank loan, but then the rest of them, we didn't have to add that in. So those are the liabilities for our company we're watching, and I am looking forward to watching everyone else's.